Hello and welcome to BCC TV. I have with me a very special guest today, Shashank Singh, who heads Apax Partners in India. Shashank, thank you for talking to BCC Circle.
Pleasure. Thank you very much.
If you were to sort of map the buyout market in India for us, where exactly are we right now? Do you think it is still nascent, or do you think the market is really matured?
I would say the buyout market is still very nascent as it's defined in the rest of the world. By volume, it is tiny as a percentage of deals done. By value, it's sort of south of 10%. So I think if you compare that to certainly the West, it's a tiny fraction. But our belief is that going forward, it will be an increasing part of the market. If I look back to our pipeline, for example, last year, it was about 50% buyout and 50% large growth. I think the buyouts will be driven by a number of factors. One of them is corporate divestitures. Another one will be generational transition of businesses when a particular promoter group gets to a close to retirement age, if you like, and then there's the whole question of transition to the next generation. That was our experience in Putney, for example, where the promoter group was in their late 60s, early 70s, and the next generation wanted to do business, or wanted to do business, other types of business, and therefore wanted the capital out of the business that had been built and to invest in other areas. So that will also be an increasing trend. We're seeing it in our pipeline as well. And finally, will be around partnerships with local Indian corporates to go after assets. And again, the flip side, I guess, of the Putney deal was the partnership with iGate.
Since the time you set up shop in India, it's been like more than 5 years right now.
Yeah.
And you have done 2 deals in that time frame. So is there a sense there that you're writing large check sizes is still a difficult proposition in a market like India, when there's so much momentum happening in growth equity? How do you sort of see that disconnect?
Actually, I would look at it from a different perspective. If I look back at our deal flow, in fact, I don't think you could sort of say that there has been less deals. There have been less deals in the pipeline. I think over our 6 years, in fact, that we've been active in India, we have closely looked at about 42 transactions. We did 2, obviously. We did, out of those 42, we did diligence on about 36 transactions. So, which means spent a lot of time, effort, a lot of money on advisors, on the process, and so on. Did 2, but the vast majority, something like 28 out of those transactions, we declined in the end on valuation or various other grounds. And they've turned out to be actually, if we had done those deals at those prices, they would have turned out rather badly. So there are enough large deals, but I don't know if there are enough large deals of the right quality. And frankly, I think the same applies to growth equity as well. Because if you look at the track record of those who went out and did lots of deals, I think the returns haven't been there. If I look at the total market statistics, for example, for private equity for India, $60 billion went in over the last 6 years, 10 billion has come out. So there is a mismatch between money invested and deals exited. And so I think that applies to all segments of the market. I would actually say that there are far more firms that can write checks of $30 to $50 million in the so-called growth equity space, and so it's far more competitive. And if I reflect back on what we have heard around some of those transactions in the market, they are very broad auctions with bankers. In some cases, 24 private equity firms running after those companies and those deals, and a lot of them not ending in the right result. So listen, I think if you step back and you ask the question, is India a tough private equity market? The answer is clearly yes. But I would not actually say that, by the way, growth equity is a lot more attractive and large checks or buyouts are less attractive. On the contrary, I think there's probably less competition on the buyout side. You do have to be careful. There are returns to those who are selective in this market. Across our 2 transactions, we've invested $550 million.
Sure.
We've exited Apollo, more or less, for a 3 times return, $170 check. And iGate, which was about a $380 million check, is at a pretty attractive mark. although it's a young deal, it's 2 years in our portfolio. I think slow and steady wins the race.
How important is India as a market for Apax?
It's a very important market. I'd say to step back, the three emerging markets that we have operations on the ground in are India, China, and Brazil. We are also exploring Russia as a market. Our experience has been early experience in the three markets where we have investments on the ground. Again, India, China, Brazil has been very good. We have adopted the same strategy in each of these markets that we have globally, which means we invest in our 5 sectors. It means we've done larger deals in respect of each of the markets, but deals that fit our strategy globally and from a size perspective, and deals that I would call true, quote-unquote, true private equity transactions. So they're either buyouts or significant minority growth deals. They're deals where we have the requisite governance and exit rights, and where we can truly add value to the companies that we invest in. And we have 6 deals across these 3 markets. And I think we're quite fortunate in that all 6 transactions have done well. And so, that has brought home to us the fact that we have a method which, when transposed to each of those individual markets, has done well.
Interesting.
And so in that context, India has an important place. I think, we have invested roughly the same amount of capital in these 3 markets, each of these 3 markets. So, it's an important area of growth for Apax, and has had a good experience so far.
And so how does India look like from a return perspective in the value chain? The emerging markets are from like India, China, and Brazil.
They're all roughly on par. Our first exited deal actually out of all the markets has been in India. Okay. So that's been a good experience. And we don't, the way we do capital allocations at a fund level is not on a country basis, but on a deal by deal basis.
If you were to go back in time, is there anything you plan to change about your India strategy, India for
it would be very easy to say, I wish we'd invested more capital, right?
Mm-hmm.
But I think if you look at the track record of the market, putting more capital out may not have resulted necessarily in the returns. At the end of the day, we're not in a market share business. We're not in a business of money invested. We're in a business of money return, right? And profits to our investors. And from my perspective, we're building a business for the next 20 years. The market is growing into our size. The market is growing into our strategy. And so, I'm quite confident that we now have the building blocks for the next 15 years of our business here. Future will be very bright, I'm sure.
Would we see Apax Partners perhaps picking up large check size and IT companies from open markets? Is that a strategy which you really pursue? Or you really believe in classic private equity investing, 5-star?
Yeah, there are hybrid funds. Nalanda is there. Westbridge has now sort of gone into that strategy. It's a valid strategy. It's not what we do. So the short answer to your question is no, you wouldn't find us doing that. As I said, we're very clear on our strategy around private equity, what we're good at, and we tend to stick to our niche.
LPs often have this comment that India is not necessarily a beta player, you have a cherry-pick fund manager. How do you sort of create alpha? Creating alpha, I think one thing is about operational enhancement, getting very close and work.
100%. So I think there was, if an LP perspective, if I kind of look at this market, there was probably too much excitement in the 2005 to 2008 time frame.
The benign days.
The benign days. Too much money went into the market. It became overcapitalized. There were too many funds, too many first-time funds, and indeed first-time investors got backed. That party has its inevitable hangover afterwards as well, right? And so, I think we're now in the regret phase. We're in the hangovers, right? You regret having too much the night before, and then when you have a sore head, then you kind of regret what you did. So that will also play itself out, and at least my perspective is one of the ways it will play itself out is that the fund managers who really have proved themselves through the cycle, up and down, are the ones that will get funded and backed. So there will be plenty of funds who will not be able to raise second and third funds because of kind of what their portfolio looks like and what they did in the party phase. And that will also be true, by the way, for the global funds. There will be churn amongst the leadership of the global funds, especially those that haven't done particularly well. So that will play itself out over the next few years. I do agree India is not a beta play. India is an alpha play. And to give you an example, Apollo, the Apollo share price in rupees was, over the period of our investment, was up 3.3 times versus the market being up 1.3 times over the same period. So 2x of alpha over that period. And if you look at some of their comps in the hospital space, in the healthcare services space, over the same period, they have not produced any alpha. So it's not like it wasn't just sectoral beta that raised all boats.
So what is a model for private equity that works in India?
I think there's no shortcut. First of all, it's really understanding what you're investing in. So if you don't really understand the sectors, I think you will struggle. B, it is rolling your sleeves up and changing the trajectory of the companies. And the reality is, especially in our check size, a lot of these companies are public already. And our investors, our LPs, are large sophisticated institutions. A lot of them are accessing the Indian public markets on an independent basis. Why should they pay you the fees along the way, right? So the question we ask ourselves with every deal, how are we changing the trajectory of this company from what it can do on its own? And it's not just about cash. And if the answer is you're not, there are other investors who can.
Absolutely. So going to this consolidation in the industry, because of the fund not being able to raise money, the way forward is alpha creation.
Yeah.
That means engaging more actively with the portfolio companies. What are the foreseeable trends in the industry as you sort of see going forward?
I think a couple of the trends will be what I referred to earlier. I would see the emergence of the buyout market, and that naturally plays into this strategy, because buyouts is fundamentally around alpha creation. It is around really driving value in the company's favor, because you're either, the only reason you will get a buyout or the ability to buy something is A, you either paying a pretty high price, and therefore then how do you create value? Or B, in some senses it's a bit of a broken. And again, you need to have value creation. The third point rather around the market evolution is buyouts, which we very firmly believe in. And then the fourth point I would say is you'll find a lot more specialization. You'll find firms will say and will start to articulate their strategy as saying, I am good at venture, so that is what I will do. Or I'm good at buyouts, so that is what I will do. This sort of everyone playing, global fund saying, I'll start looking at deals at $30 million and go all the way up to $500 million. I think you're going to see less and less of that.
So what's the sweet spot for Apax Partners?
So the sweet spot, as I said, is 5 sectors, either buyouts or significant minority growth deals. Check size of between $200 and $500 million.
You'll not go lower than that?
We do look at stuff slightly lower than that, starting at about $100 million.
And this for market like India, particularly?
Yes, yeah. But 200 to 500 is also roughly where our global average is. It's slightly lower at the bottom end, but it's roughly where we are look at deals globally. Our goal is really to do between 2 and 4 deals per fund. So, funds investment cycle is 4 to 5 years. So over that period, we'd look to do between 2 and 4. In previous fund, Apax 7, we did 2 deals. We've just raised Apax 8, and I'm hoping that we do ideally a couple more.
And that would be in the range size of 100 million upwards, not necessarily 200 million.
In the sweet spot of 2 to 5.
How does your pipeline look like, and what are sectors where you see the breakout is really happening?
So we're pretty busy at the moment. There's a number of deals that are actively being considered. The pipeline is again the mix between buyouts and significant minority that I described earlier. Of the 2 deals that are currently actively being worked on, one is a buyout and one is a minority. So it's a reflection, I'd say, on the micro side of what the macro trend I described for last year. All of our sectors are active right now. We're seeing deals in tech, we're seeing deals in financial services, in healthcare, in retail consumer. So really across the board. So I can't point to any specific trend, to be honest, in terms of one sector being more of a breakout than another.
What are the challenges that you're facing building out the Apax India platform?
That's a good question. What are the challenges? I think one of the challenges is how do you how do you manage a larger portfolio, right? Because if model is to be very actively involved, that's very resource intensive from the GP side. And so managing, doing deals, working with the portfolio with the team size that we have, I think it is a challenge, and I think that's a challenge probably a lot of people face. The second challenge is just around the regulatory environment, and I'm not talking about kind of macro regulation. I think that's part of doing business, but I'm talking around a lot of uncertainty around securities regulation. What are the rules around IPO? What does SEBI come out with this week, for example? What is happening on the tax side? So that produces a lot of uncertainty and a stop-start in our business. So greater regulatory clarity and coordination between the various bodies, I think, would be helpful. And then the final challenge, I'd say, is just a very choppy market. On the one hand, you've got a lot of FII money coming in, the Sensex is up 19,500 and so on. On the other, more mid-cap companies, which is where we are active, are not seeing a lot of those flows. And yet people want to benchmark off of the Sensex. And so, getting a deal done, making buyer and seller meet at a point where you're agreeing on price can often be quite challenging.
The buck sort of stops with you at Apax India platform, but how is it building that as an institution? Is it intent to hire more partners? I think if you look at the history of Apax, you had Neeraj, and of course you had Sandeep also, most of transition out. So what is the intent there of building on, given to say it's resource intensive, the entire exercise?
Yeah, and that is part of the challenge. We have a culture where we tend not to hire partners or people at the partner level. We tend to grow our own. And on the one hand, that is a very time-consuming and resource-intensive process. But on the other, given that there is something unique to the Apax culture, we believe, and that you need a lot of informal links, if you like, and experience and trust to really get deals done. Your committee needs to trust you that you're doing the right thing. It needs to have seen you over a number of years in a number of different situations to see how you react, to judge your own investment judgment, and so on. We feel that it is best to grow our own over a period of time. In fact, the most successful partners at Apax around the world have been those who started as associates. And so that's our model. I would love for my team over time to kind of step up and grow into the role rather than hire outside. And in fact, I have all full confidence that they will over a period of time. It gives everyone the opportunity to grow.
Okay, interesting. And there also media reports that suggest that Apax Partners is downsizing its operations, like globally, to shut down some operations in Europe and some part of that world. Does it hold any ramifications for a market like India?
No, not at all. And I think, listen, all businesses go through change. And the reality is that if I step back and I sort of see the evolution of where we invest our capital over the last 5 years, Europe as a proportion has come down. The US and more recently the emerging markets has gone up. And I think that trend will continue into the future, because from our perspective, we invest our capital, our money in our sectors, in the best deals in our sectors globally, wherever they may be. And as the weight of the global economy shifts more and more towards other geographies, I think that will be reflected in how we invest our capital, and that will be reflected in where we as a business make investment decisions, i.e. where we'll have offices, where we'll have teams and so on, which are for a private equity fund, their investment decisions. That's a natural evolution of any business as such.
Okay, my last question to you. If you were to give me like one deal which happened in like recent time, which you really admire the most, which some other PE fund manager has done, what would that be?
It's a great question. I mean, I think there are a number of deals that I admire. The first point of admiration, I would say, is returns, really. And so the best return deals are the ones that one should really focus on. A. B. Deals where a private equity fund has gone in and really changed the trajectory of the company, added a lot of value, brought in management, are deals that I'd say, okay, those those are also praiseworthy. And so, there are a number of examples of recent exits which have been very good exits for people, for some of our competitors. Paras is one that I admire. Alliance Tires is one which again has been a buy and a build, and very successfully done by Warburg, because that is true alpha in my view. Beta deals, you buy low, sell high. You invested in 2003 when the Sensex was 2300, and you sold in 2008 when the Sensex was 21,000. Lots of people have made money that way. But coming in a tougher market and really identifying a great manager in a great industry and being able to add value, I think that has been TPG's exit on Shriram Transport Finance again, and those are all great deals in my book.
Thank you so much.
Pleasure.
Thank you for talking to VC Circle.
Pleasure.
Thank you.
Thanks a lot.